Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Phil Mackintosh, Chief Economist at Nasdaq, Max Cabasso. He is Managing Director on Nasdaq's Market Intelligence Desk, and Dr. Russell Rhoads, Associate Clinical Professor of Finance at Indiana University Kelley School of Business. We're here to discuss rotation in the market and fundamentals are still intact between what we're seeing with the tech rotation as well as jobs data that came in recently. Russell, we'll go to you first. And
Sure.
Being the derivatives guru here, it's a great time to have you on as we're looking at volatility in the market. Certainly no shortage of it to kick off the year.
Yeah, and the Nasdaq Volatility Index, it's hitting, it's started to make new highs for 2026 after kind of not reacting in the way that you would think that it would in the little sell-off that we got back in January. But going back to October, we have continuously gotten some sort of sell-off, and it seems to have been about mid-month in October, November, December, and January. Looks like it's come a little bit earlier in February. But what's a bit more startling about the more recent Nasdaq index sell-offs is just the reaction that we're getting out of VXN, or the Nasdaq Volatility Index. Typically, if you're concerned about downside, you would take volatility making a new high when the market is selling off as kind of a confirmation that move may continue.
Yeah, and certainly, Max, part of it's attributed to the shift that we're seeing from that broad AI-driven optimism toward greater differentiation among companies. That's a narrative that's been playing out since last quarter.
Yeah, we've kind of been waiting for it. We talked about it for almost 2 years, it felt like, kind of waiting for that rotation. We're finally starting to get it. Obviously, you see the headlines, software in particular really under pressure, a lot of tech under pressure. But when you look at it, broader S&P 500, about 1.5% away from all-time highs. So it's kind of that bifurcation. You're starting to see the defensive cyclicals really start to outperform, new leadership, energy holding up. So again, we've had this run, we talked about it for a long time, of where would the market be without the semis, without the AI trade. Now that same AI trade is kind of reversing and hitting some of the software stocks, but we're seeing other market leadership really take over, like I said, in some of those cyclicals. The staples have really started to do well. Biotech, healthcare starting to turn around again. So starting to see, again, just kind of broader momentum. We're still, again, holding up to the upside, very close to all-time highs, even with this big drawdown on the technology side.
Yeah, and Phil, if we look at it from a macroeconomic perspective, of course, you have the disruptive impact with AI on existing business models, and of course, jobs data has been a little bit light as well.
Yeah, but I don't personally think AI is the reason the jobs data is light. There's a lot of people say they're looking at putting AI into their businesses, but at the moment, it really doesn't look like people have lost their jobs. Maybe they're being redeployed into working out if the AI can be deployed. But there was a really interesting survey that came out that said companies that were looking at AI, the staff were less worried about losing their jobs than the companies that hadn't started. So I think AI will probably increase productivity in the longer term, but right now I think it's just redeploying people to actually look at it. There's not a lot of evidence that the AI itself is causing people to lose jobs yet.
Yeah, which is interesting because there certainly is optimism in terms of adopting these sorts of technologies at the management level, but it's to your point, how many are actually using it day to day? And then how do you measure that? Are these investments going to provide some sort of return if the workforce still isn't there yet?
Yeah, I mean, I think eventually it's going to be like what we do with Google search. Like, you don't even think twice. You type in what you wanted to find and it gives you the answer. In the old days, you would have to go down to the library and get out microfiche and spend ages trying to find the data you needed. Like, it will make us more productive, but we've got to work out how to probably put it into products and how to get it really to work for the workforce as well, to make us more productive. Like when you're doing your research for all these segments, it could probably make you a lot more productive once we get it working, not hallucinating. But I think right now, like, they're still refactoring the models. The models are getting pretty good, but the next phase will be productivity.
Yeah, I agree with you. I mean, I certainly use it every day, and it's just, it leads you to better research because it helps to streamline some of those efficiencies in terms of prepping for the show and outlines and so forth. So certainly those types of use cases are there. Russell, I want to go back to the volatility for a moment here. Are there other areas in the market outside of the Nasdaq 100 that either a pause for concern or something that you're keeping an eye on?
Well, I'm keeping an eye on small caps, and my concern about small caps is we've had consistent underperformance for almost a decade. And from an academic standpoint, one of the factors that's supposed to lead to long-term outperformance is focusing on small cap stocks versus large cap stocks. And that just does not seem to be the case anymore. And I just worry a bit that investors may try to find a place to put money if they're concerned about the AI trade, et cetera, and may turn to small caps, which may not work out as well as they hope. And I've kind of got an overarching theory on this one, that a lot of companies that used to go through a process where they would go public as they were just becoming profitable and end up in the Russell 2000 and then work their way up into some of the larger cap indexes, they're skipping that step and going public as mega caps. In fact, we have a few very large companies that are talking about going public in 2026. And I think what has happened is private equity is where you're getting that small cap exposure, and then the private equity guys are cashing in when the companies go public. So I feel like there might be some sort of structural market change that makes small caps not as attractive as they've been years ago, and maybe not anytime in the near future.
Yeah, Phil, what's your thoughts on that?
It's true that a large proportion of the Russell 2000 companies are actually loss-making companies, but one of the really positive things that we've been starting to see is small cap companies are returning to profitability, and they're growing their earnings now probably faster than the large cap companies. So I know the performance has been outperformance of the small caps relative to the large caps. We've seen that shift, but it is supported by the earnings changing as well. So I think interest rates coming down is a positive for small cap. I think they're starting to see sales coming back to them and margins increasing as well. And so there's actually been an improvement in the profitability of the small caps, which supports the stock prices.
Yeah, and Max, that's something that we have discussed a number of times, where you can't just base your fundamental thesis on the fact that interest rates are moving lower. You do need to be able to show that revenue and clean up the balance sheet, to Phil's point. And I think it's almost an overarching theme for what we're going to see this year. We could be up, maybe we could be down, but I don't think it's going to be a straight line either way.
Yeah, I think there's going to be a lot of gyrations. We've kind of seen this before. When you even go back to last year in April, we had the tariff announcement, massive sell-off. All right, it's over. The way we've kind of done business is over, and then we rebounded and have doubled since. So I definitely don't think we're going to be in a straight line. We've seen this play before. Again, small caps now, again, fundamentally are looking at it like they're in a stronger position than they have been. But I've been a part of that trade, waiting for that compression between the large caps and hoping the small caps start to outperform. It starts to get close, and then something else changes. We have a new AI moment, and it changes. So again, I don't think this is going to be a steady, up and to the right sort of market this year. There's a lot going on: geopolitics, local politics, midterms. There's just a lot that can change. So again, you really need the fundamentals behind it in those small caps to improve. But then again, they seem to be that they could be the bigger target of AI replacement, because they don't have these giant moats around their business model. So again, I think we could be in for a choppy ride. Even if it is to the upside, I don't think it's going to be a steady, we're just going straight up and to the right all year.
Yeah, and Russell, I see you shaking your head in agreement. What can you tell us, maybe from a historical perspective, how this compares to other periods?
Well, no, I was nodding my head yes, because Max was like, I've been on the trade, long small caps, short large caps, and maybe I've been trying that trade for too long, and that's one of the reasons that I have a little reluctance to jump back into it. You get a little exhaustion when things haven't necessarily worked for you. I would like to just mention one thing with respect to what software stocks did recently in a single day. It's, the AI theme. All of a sudden, there's this thinking, well, this may replace some of the demand for off-the-shelf software and services, et cetera. And we had a really detrimental day for those, just based on that theme. And normally, it feels like themes usually work their way into the market over time. But with respect to AI, and maybe with the internet bubble still being present in some of our minds, everybody wants to be the first one out the door if it looks like this thing is turning. That's also the kind of volatility that you see in the market when we're around market tops.
Yeah, it certainly is, and it feels like, Phil, that this wasn't one of those buy the dip kind of moments or a FOMO moment. It's actually played out, over a couple of sessions and not just reversed.
Yeah, but as Max says, we're seeing rotation. I mean, the thing we haven't talked about yet is metals prices, and so far this year, it's not been about AI. AI's been kind of selling off. Metals have been really strong. Some of the energy complex and materials complex is strong because of that. So we are definitely seeing investors changing their behavior compared to what we saw pretty much the whole of last year.
Yeah, we certainly have, but gold and silver were under some bit of pressure as well.
Yeah, I mean, they obviously went parabolic for a bit. There was a lot of rumors, kind of what was causing it, and then there was the sharp sell-off. Gold has kind of turned it around, rallied yesterday, kind of flattish more, this week. So there's been a lot of chatter there. That felt almost like the new momentum trade for a while, just because it was going. There's a lot of debasement trade. This is what's happening, but obviously you're seeing Bitcoin kind of go the other way, which seems to be just kind of a risk sentiment in itself at this point. Again, so that the materials move, obviously, though, silver in particular kind of goes into the AI trade. It's a component. You need it. There's been a lot of talk there. That really, this kind of last leg has been seemingly more of a momentum trade than more fundamentals on kind of why you were buying them. But they have outperformed. That's kind of been the leader here. But the other thing, this hasn't seemed like a buy the dip moment just yet, but we kind of had this moment last year with DeepSeek. We had the DeepSeek moment where, all right, NVIDIA is now in trouble. Everything we thought about compute and the build-outs is not going to be needed anymore, and that reversed. That didn't actually change the thesis, made it kind of more effective in a sense and more useful, but it didn't crush the entire narrative. Seems like the same with software, so kind of want to see it play out over a longer period of time. These quick flash moves that we saw tend to reverse themselves because, like you said, normally you start to see it work in, and it's a slow decay versus kind of just a plunge, whereas we've seen these really volatile moments in some of these sectors, again, software in particular, where just because a new product was announced, now all of a sudden it's game over. Yeah. Those tend to be, in my opinion, bought. There's a bit of an overreaction, so that's why, again, this year, I don't think it's going to be kind of a straight move one way or the other. I find it surprising, how big of a sell-off you've seen in some of these spaces, where the fundamentals behind it haven't shown that they're really going to be in trouble. Now, maybe in the future, those multiples will be compressed. They're not going to get back to where they were previously, but to say that, AI is going to just change the entire game for software, I think there's a bit of an overreaction. And again, like I said, we're at highs, people taking profits. You understand it as well. I've had companies reach out, hey, what's going on? It's like, look, you've outperformed, you've crushed it the past year and a half, 2 years. Investors are allowed to sell and take profit and rotate into other sectors. Like I said, basic materials are outperforming so far this year. S&P still just off all-time highs. So it's not like the entire market has turned. It's really just a rotation. So the market still seems healthy enough that we're not worried about a financial crisis or anything. Yeah. It's really just
no one's talking recession.
Right. It's just these stocks have done so well. It's okay to take some money off the table and protect yourself a bit. Yeah,
I would also argue too, Phil, that it could have been a bit of an overreaction. There are still SaaS companies where the nuance is in terms of how platforms are using them. Even if you think about it from a security perspective, it's not going to be all moved over to one sort of AI platform or not. There are nuances with different types of companies and how they're using software and how that's been integrated in a number of areas of the company. I don't think it's something that you're just going to stop and start using AI, perhaps a hybrid situation. It's almost, if you think about it like the cloud, you saw a lot move over, and now you're seeing somewhat of a hybrid position there.
I mean, to a degree, most companies exist because they're really good at doing a specific thing, and the reason that like Nasdaq uses somebody else for our HR software is because they know how HR software needs to work. So I think the skill set of the humans with the ideas are still going to matter, even if they're vibe coding. There's still going to have to be the creativity, the synchronization, working out what the customer needs. Having a sales team to go and talk to the customer is something that's kind of hard to do instantly, and it's definitely hard to do with a single person vibe coding in a garage.
So of course, I mean, again, back to the governance, cybersecurity perspective and all that. I mean, especially in industries that are as heavily regulated as ours, you just don't flip a switch. Dr. Rhoads, while we have you, and within the derivatives and finance space, from an academic perspective, how has it changed the work you're doing or the type of work that you're seeing?
Well, I'm luckily I am teaching equity investments this spring, and I've been using AI as an example with respect to, typically when you're looking at investing in a company, you want to look at the cash that's going to be generated on your behalf when you invest in the company. And when companies decide that they want to invest in a big capital project, it's the same sort of thinking. And where I feel like there might be some sort of a disconnect is, AI is great. AI makes my life a lot more efficient. I think I'm paying $20 a month for something, but I don't see where there's going to be synergies. There's going to be increase in profit margins, but is the present value of all of these benefits equal to the billions of dollars that we hear being spent to get up and running with respect to AI? And I have a hard time visualizing anybody getting a decent payoff on some of the really large investments that are being made right now. And I believe some of the technology companies have altered how they go about accounting for their depreciation. They're kind of stretching out the life of some equipment so that it looks like they're maintaining some profitability in the face of higher expenses to play the AI game.
Yeah.
I mean, I think there's a way to think about the economic benefits, and that is looking at the internet. The internet build out cost a lot of money, but the 10 years after all the connectivity happened, we had more than 1% uplift in GDP for 10 whole years. If you do that now just to the US economy, that's $30 trillion economy, add 10%, that's $3 trillion. So we're spending about $500 billion a year building out all the data centers and the LLM models at the moment. I think the cost benefit from the economy's point of view is there. I think Russell's point might be like, how do we pick the stocks that are winners and who is actually going to be able to extract the rent?
I also think on that point, we've heard so much the past 5-10 years about the gripes of it's no longer a stock picker's market, everything is passive flows are really dominating everything, that's carrying the weight. These type of moments, it feels like it could go back to being that stock picker's moment where you find stocks that are going to perform, that actually have a moat around their business, that have really impressive data that only they have, that nobody else can get, that all these AI systems can try to vibe code and create these new software platforms, but if you don't have the data that goes with it, it's not valuable. So there are going to be winners and losers, but it's going to give opportunities for individual stocks to really outperform because of that moat that they have around their business that are in this moment, this time period, are kind of getting thrown out with the bathwater. Again, there's going to be some losers, but I think there's still going to be plenty of winners that have their core business intact. Like you said, the experts that you're still going to go to, the enterprises are not going to kind of build it out themselves. You're still going to need those other providers. And those that have a moat around their business are going to end up being winners and, again, more efficient with their time and scale with AI.
Certainly, which is why the barbell approach, even though it's a longer-term investment strategy, has proven to work out well. If you're looking at different types of investments and not just putting everything within one basket, I think that might be, it doesn't have to necessarily be a stock picker's market, but I think a big question that's going to come up, Phil, is how do we value data? Right. I've asked this question in virtually every panel that we do. How do you quantify that, right? Because it is a very subjective
I think the bigger
matter.
question at the moment is there too much free riding of the data that's in the clouds? So like if I write some analysis, how do I get paid for my analysis? If it goes on the internet, everybody can use it and everyone can learn from it. So I think keeping your own IP over the data is going to be an interesting challenge too.
Well, we are starting to see that payments essentially for the models having to go out. I know there's issues with potentially Google because their search and how they essentially have 3.5 times more data than any of the other LLMs because of their search and having to create a second bot. But for tokenized payments between the AI models, the foundational models, and the content providers, so you actually can start to receive some payments for that data, for everything that you're putting out there. You can actually, as the content creator, start collecting on some of that as well. So I think that'll be worked out, but that's definitely a big factor, going forward. Again, because it's all about trash in, trash out, good data in, good data out. That data is really the
well, think about all the non-human identities that are scraping as well, right? So it's hard to, effectively model it out, and it's still somewhat, Russell, I think it's still a little bit subjective. How do you place a value around this?
I know from personal experience, I'll use ChatGPT to double check numbers or ask a historical number every once in a while, and I'll get a response that can't give me a really good answer because the data needed to do so is proprietary, and then it will ask, can you upload the data to answer this? Well, if I can do that, I can do it by myself. But there's a point there, and Max was just talking about the tokenization there. Yeah, if I was asking ChatGPT a question about the valuation of a company or some sort of historical number, and it came back and said, the numbers are proprietary, but would you be willing to spend 50 cents to get it? That might be a great revenue stream. I think a lot of people would be willing to spend a couple of bucks to get some of the, just a small piece of proprietary data. that they need to answer a certain question. And that could end up being a very nice revenue stream for those companies.
Yeah, it certainly could. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.